Hi guys, so on Thursday Chancellor Jeremy Hunt set out plans to fill a £55 billion hole in the government's finances through a combination of tax rises and spending cuts. The deficit was created by former Chancellor Kwasi Kwarteng's now infamous mini-budget, which sparked chaos in the financial markets and led to a steep increase in government borrowing costs. Just under half of the £55 billion will come from tax rises, with just over half coming from cuts to government spending. Jeremy Hunt added that once the UK's economy had recovered, the pace of fiscal consolidation would be increased to reduce pressure on the Bank of England to raise interest rates. The Office for Budgetary Responsibility, or OBR, which provides independent analysis on the government's finances, confirmed that the UK is already in recession. But Hunt said the OBR expects the downturn to be shallower because of the measures in the autumn statement. The OBR forecasts the economy will grow by 4.2% this year before contracting by 1.4% in 2023, with growth recovering to 1.3% in 2024. Meanwhile, inflation will average 0.1% this year before starting to fall steeply from the middle of next year. Unemployment is expected to rise from its current rate of 3.6% to reach 4.9% in 2024 before falling back to 4.1%. So which taxes are going up? Income tax. The Chancellor announced that the threshold at which the different rates of income tax kick in will be frozen at their current level for 6 years. This means the basic rate of 20% will be charged on all earnings over $12,570 until April 2028, while the 40% rate will be charged on earnings over $50,270 until the same date. Meanwhile, more high earners will be pulled into the top rate of income tax, with a level of income on which the 45% rate is charged being reduced to $125,410 from $150,000. The move will cost those earning more than $150,000 around $1,200 a year. The threshold for national insurance for individuals will also be frozen. Stamp duty. Kwarteng's increase to the threshold at which stamp duty is paid to $250,000 was one of the few mini-budget measures that were not reversed by Hunt when he took office. But he announced that the increase will be temporary, with the threshold falling back to its previous level of $125,000 after the 31st of March 2025. The threshold for first-time buyers will also be cut to $300,000 from $425,000 on properties costing up to $500,000 rather than $625,000. He justified the measure by saying that activity in the housing market was expected to slow down over the next 2 years, and reverting back to the former stamp duty threshold in 2025 would encourage people to bring forward purchases. The move will cost people purchasing a home for more than $250,000 in higher stamp duty payments. This announcement of a reversal of the recently announced stamp duty charges in 2025 signifies a need to reform stamp duty, which is now starting to resemble income tax, where it's the top tax bands generating the greatest receipts. This reversal will make it increasingly difficult for prospective first-time buyers to get onto the housing ladder in the coming years, particularly in London and the South East, which accounts for the majority of stamp duty receipts. Council tax. Hunt has lifted the cap on council tax increases to give local authorities more freedom to raise cash. Local authorities will now be able to raise council tax by up to 5% without having to hold a referendum on their plans. The impact of the move will vary from council to council, as well as according to individual property bands, but it could see the average amount charged on a Band D property rise, for example, from $1,966 to as much as $2,064. Capital gains tax. Capital gains tax is charged at a rate of 18% on residential property and 10% on other assets for basic rate taxpayers, and 28% and 20% respectively for higher rate taxpayers. But the first $12,300 of gains are tax-free. However, Hunt announced that he was reducing the tax-free threshold to $6,000 from April 2023 and to $3,000 from April 2024. The move will impact investors who sell buy-to-let properties, but the tax is not charged on the sale of people's main home. inheritance tax. The threshold at which inheritance tax also starts has also been frozen at its current level of $325,000, although couples can still combine their allowances, and assets left to a spouse or civil partner will not be liable for the tax. In another blow for people planning to leave their family home to their children, the Chancellor also announced the introduction of a cap on social care costs, which would be delayed by 2 years. The cap had been due to come into force in October 2023 and would limit the total amount individuals had to spend on social care as they aged to $86,000, after which the state would step in to foot the bill. The cap would have reduced the number of elderly people who had to sell their family home to pay for care. So what support is available? Hunt had previously warned that the energy price guarantee, which limited average household energy bills to $2,500 a year, would be reviewed at the end of March, sparking concerns that it could be scrapped altogether. But there was good news for struggling households, with Hunt saying it would remain in place but be increased to $3,000 a year for a further 12 months. Although the move will cost a typical household an additional £500 a year, the sum is significantly less than they would have to pay if the guarantee was abolished altogether. He also announced that people on means tested benefits would receive a one-off £900 cost of living payment, while pensioners would get £300 and those on disability benefits would receive £150. In addition, the state pension and means tested benefits will be increased by 10.1%, in line with the level of inflation as measured by the Consumer Price Index in September. People who rent their home from a social landlord will have rent increases capped at 7% for 2023-2024. But what does this mean for the mortgage market? It's too early to say how the financial markets will react, but the statement is expected to reassure them after the chaos caused by the mini budget. Not only does Hunt set out exactly how he plans to fill the government's budget deficit, but he has also published the OBR's response to his plans. The interest rates charged on fixed rate mortgages had already fallen before the statement, and they are likely to continue their downward trend following it. Hunt's announcement that the rate at which fiscal consolidation would take place would increase once the economy returned to growth also means the Bank of England will be under less pressure to raise interest rates, which is further good news for mortgage rates. Thursday's autumn statement has highlighted the importance of getting inflation and mortgage rates under control before announcing a raft of measures, both tax rises and spending cuts, in an attempt to achieve that goal. Whilst the medicine will be painful for many, for mortgage borrowers, spiralling inflation combined with consequential higher interest rates is punishing. We are hopeful that these steps will result in the Bank of England base rate peaking around 4% as now predicted. But what does this mean for the housing market? Well, in all honesty, the statement is a bit of a mixed bag for the housing market. Activity has already slowed in the face of higher living costs, rising interest rates and economic uncertainty. The freezing of the income tax thresholds combined with higher council tax and energy bills will do little to change this. That said, the continuation of the energy price guarantee from April, albeit at a slightly higher level, will reassure consumers that they will not face a steep increase in their gas and electricity bills come the spring, and could go some way towards increasing confidence. Meanwhile, news that the threshold at which stamp duty is changed will fall back to £125,000 in April 2025 may cause some people to bring forward their purchase. The fact that employment should not increase significantly should also help to prevent a high level of forced sales, while the overall stability the statement brings is also good news for the housing market. The one area of bad news is the decrease in the capital gains tax allowance in 2023 and 2024. Some commentators have warned that the move could prompt small-scale buy-to-let landlords to sell their properties ahead of the decrease, further intensifying the shortage of homes in the private rented sector. So that really is a bit of a recap and a review of the autumn statement. If you do have any questions or you would like to discuss anything, then please feel free to give us a call and we'll be more than happy to speak to you. Take care, guys.